If you've been curious about investing but don't know where to start, or if you've been investing for a while but feel like you're doing it without a proper system, this video is for you. In the next 20 minutes I'm going to give you everything you need: the mindset, the tools, the process, and the specific steps to start investing intelligently using AI. This is the video I wish existed when I started. This is a long one. I've organized it into 5 chapters so you can jump to what's most relevant. Chapter 1: The Foundational Mindset. Chapter 2: Setting up your toolkit. Chapter 3: Finding your first investments. Chapter 4: Building your portfolio. Chapter 5: Ongoing management. Let's start from the beginning. The number one thing that determines investment success is not intelligence, financial knowledge, or access to information. It's time horizon. Investors who think in decades consistently outperform investors who think in months. This is not a platitude, it's the most robust finding in 50 years of investment research. The S&P 500 has never delivered a negative return over any 20-year rolling period in history. Your job as an investor is to stay invested long enough for compounding to work. The second mindset principle: your portfolio is a business, not a casino. Every holding you own represents a share of a real business with real employees, real customers, and real earnings. When you buy a stock, you're buying a fraction of that business. When the price drops, ask yourself, has the underlying business deteriorated, or has the market simply become temporarily pessimistic? That question leads to far better decisions than watching charts. You need 4 tools. All have meaningful free tiers. Simply Wall Street for stock health screening. Koifin for financial data and charting. Seeking Alpha for news and earnings analysis. ChatGPT or Claude for analysis assistance and learning. Set up accounts for all 4 before you make your first investment decision. These are your instruments. You wouldn't try to fly a plane without instruments. Spend at least 1 week just exploring these tools without making any investment decisions. Look up companies you've heard of. Read their snowflake scores, their financial summaries, their recent earnings coverage. Build familiarity with the interface and the language. The biggest mistake beginners make is rushing into their first investment before they understand the tools they're using to make that decision. I recommend that every beginner starts with their circle of competence. Make a list of 10 to 15 companies whose products or services you use, understand, and believe in. Then put each one through your AI toolkit. You're looking for companies that are financially healthy, simply Wall Street score above 3/5, trading at a reasonable valuation, P ratio below industry average, or justified premium growth, and showing positive analyst sentiment, seeking alpha score positive and improving. From your list of 10 to 15, you'll typically find 2 to 5 that pass all 3 filters. These become your shortlist for your first investments. Do not invest in all of them at once. Start with your highest conviction pick, deploy 50% of the capital you've allocated to that position, and hold the rest in cash to add to the position if the price falls further after you buy. This is called staged entry, and it significantly reduces the psychological damage of buying at a short-term peak. Over your first 6 to 12 months, build toward a portfolio of 15 to 25 positions across at least 5 different sectors. This level of diversification eliminates the risk of any single company's problems destroying your portfolio, while remaining concentrated enough that your research on each holding actually matters. A simple starting framework: 40% in large-cap quality growth companies, 30% in dividend-paying value companies, 20% in index funds for broad market exposure, and 10% in a higher risk, higher potential theme or individual stock bet. Adjust this based on your personal risk tolerance and time horizon. Younger investors with longer horizons can reasonably hold less in dividend value and more in growth. Successful portfolio management doesn't require hours every day. It requires a consistent weekly process. Mine takes about 45 minutes per week. Sunday evening, check the earnings calendar for the coming week, Koifin, free. Review seeking alpha sentiment scores for my top 10 holdings. Look for anything that has changed significantly. Monday morning, if any company in my portfolio reports earnings this week, I run the AI earnings call analysis I described in a previous video as soon as the transcript is available. Quarterly, run your full portfolio through simply Wall Street's screener and check whether any holding's fundamental score has deteriorated significantly. A stock can fall in price without its fundamentals deteriorating. That's usually a buying opportunity. A stock whose fundamentals are deteriorating while the price is falling is a different situation that warrants a genuine reassessment of the thesis. That is the complete framework, mindset, tools, process, portfolio construction, and ongoing management. If you made it this far, subscribe because every video on this channel builds on exactly this foundation. I've put the full toolkit setup guide, the weekly routine checklist, and the portfolio construction framework as a downloadable PDF in the description. It's completely free. Go get it, set up your accounts, and I'll see you in the next video.